Okay. So, again, this week, for you guys that just jumped on, this week we're going to talk about working capital, complete the cash flow, use the cash flow to drive the balance sheet, really get the core bulk of the model together. Next week is focusing on the interpretation, getting into valuation. So, we mentioned the idea of working capital, right? Working capital is your current assets less your current liabilities, right? An asset is a resource who's expected to provide some future economic benefit. A current asset is a resource whose benefit is expected to come within the year. So examples of current assets are like cash, accounts receivable, inventory. A liability is a debt or obligation on a business. And a current liability is a debt or obligation who's set to come due within a year. Short-term debt, accounts payable, accrued expenses. So working capital is a measure of the current assets less your current liabilities. What does that look like? Well, your current assets less your current liabilities would help be an indicator of how well will your resources that should be converted into cash this year cover the liabilities that are due this year. So in some sense, you would hope your working capital to be positive. Maybe. There's two sides to working capital. In modeling, however, we focus on a narrower definition of working capital called operating working capital, which is current assets not including cash and current liabilities not including short-term debts. So why do we care about current assets not including cash and current liabilities not including short-term debts? Well, when you strip out cash and short-term debts, you're left with accounts receivables on the asset side, prepaid expenses on the asset side, inventory on the liability side, accounts payable, accrued expenses. These are line items that are most directly associated with your operations. Accounts receivable is related to revenue. How much of your revenue do your customers owe you? Inventory is related to cost of goods sold. It's related to what you're selling. Accounts payable is related to cost of goods sold, the cost of the products, the manufacturing costs of the products. Accrued expenses, expenses that you owe that are related to operations. So it's important for us to strip out, or we like to, in modeling, strip out cash and short-term debt because it shows us how much cash coming in directly from our operations is expected to come within the next 30, 60, or 90 days, or within the year, right? Cash could potentially mask a working capital shortfall. Short-term debt could do the same. So, we want to get strictly to just the assets that are based on our operations, our revenue, and our costs. And that's defined by current assets less cash, current liabilities less short-term debt. And so we talked about the example last week of looking at an accounts receivable that's climbing from year to year. If your accounts receivable is $10,000 this year and $20,000 next year, is that good or bad? What do we conclude? It depends. Right? It depends. Accounts receivable climbing could be bad. It could mean you have a collections problem. Why is your accounts receivable not going down? Are your customers not paying? Or accounts receivables climbing can mean maybe your business is growing. Maybe you have more customers. So you can't just look at these current asset or current liability line items as an absolute value. You have to look at them in relation to the operations that are being produced. And we do that, the convention is this measure of days. So in other words, I took the example of, well, if we had $25,000 in accounts receivable, and we had $100,000 in revenue, right? So accounts receivable we compare to revenue because accounts receivable is the portion of revenue that you did not yet collect and cash yet. So you compare your accounts receivable to revenue. So you say, all right, well, in a given period, if I had generated $100,000 in revenue and my accounts receivable balance is $25,000, that means of the $100,000 generated, $25,000 has not yet been collected. We look at the percentage of that, which is 25,000 divided by 100. 25%. So 25% of our revenue recorded has not yet been collected. And in our convention of days, we multiply that by the number of days in a year, or a lot of times we don't use 365, we use 360 because that's divisible by 12. And so 25% of 360, 25% times 360 is 90. So the idea is 90 days of our yearly revenue remains outstanding. So we're now not looking at the absolute value of AR, we're looking at AR in proportion to the revenue. So if AR is increasing and revenue is increasing accordingly, our percentage shouldn't change. Our days shouldn't change. So we can better detect if an increase in AR is a positive sign or a negative sign, right? So in other words, the idea of, I mentioned that AR increasing could be a good thing or a bad thing, right? AR increasing could mean our customers aren't collecting. How do we detect that? Well, if our AR is increasing and our revenue is not increasing, that means our days are increasing. That's a problem. If our revenue is increasing, if our AR is increasing but our revenue is increasing accordingly, then the proportions aren't changing. Then our percentage or our days should stick to around 90 days. That's a good sign. That means AR is increasing, well, because our business is growing. So in other words, that's why this measure of days helps us determine, is this increase or decrease or change in working capital line item a positive or negative? Right? If the days are increasing, then we might have a collections problem. If the days are decreasing, even though the value of AR is increasing, if the days are decreasing, then that can be a good sign. So we analyze each working capital line item using this measure of days. We calculate the measure of days, and we use this measure of days to make our projections. That's how it works. Any questions on that? All right, let's look at the Walmart model then. So here we'd left off with the depreciation. We'd linked everything up into the cash flow statement. And now we're left with these working capital line items. So the first thing I'm going to recommend doing in any model that you're working on is first look to the balance sheet to determine which working capital line items we want to base our model on. Because even though this is a cash flow statement line item, the cash flow statement is going to track the year-to-year changes in working capital. Right? So I'll show you how that works. But the core working capital line items are balance sheet line items. So in other words, if we look to the balance sheet, and let me pull up the Walmart balance sheet, we want to use the balance sheet to identify what are our current working capital line items. The reason why I'm saying this is because we're going to create our own working capital table. There's no working capital schedule in annual reporting or in GAAP reporting, in financial reporting, sorry. There's an income statement, there's a balance sheet, there's a cash flow statement. How did that happen? There's an income statement, there's a cash flow statement, there's a balance sheet. There's no working capital schedule. But we're going to create a working capital schedule because the working capital schedule facilitates a bridge between the cash flow statement and the balance sheet. So when creating the working capital schedule, we want to determine what line items are the appropriate line items that would be used for the working capital schedule. We need to go to the balance sheet first to determine that. So if we look at the balance sheet, oh, I guess did the application shut down? Is that what happened? No. Yes, it must have. So we're going to look to the balance sheet. And we're going to detect the current assets excluding cash. So let's look at the current assets here. First line is cash and cash equivalents. That's not working capital. Receivables net, that's accounts receivable. We will include receivables net. Inventories, that's working capital. We'll include inventories. Prepaid expenses, that's working capital. We'll include pretty much everything in the current assets section you would include. There's a couple of exceptions. I mentioned cash and cash equivalents. The other exception we're going to exclude is this current assets of discontinued operations because it's extraordinary. It's based on a discontinued operation. It's not based on continuing operations, right? Working capital, point of working capital is it's based on continuing everyday operations. So to determine which line items in the asset section are working capital, it's anything in the current asset section that doesn't include cash, and that's not extraordinary. It's got to be based on or supported by your everyday operations. And you'll see how this comes together. If you disagreed with me and said, well, even though it's discontinued operations, it's based on SG&A, and you put in a working capital line item for that, your projections won't be too far different. you'll see how it comes together. Don't worry about these little nuances yet too much. These are things that you'll slowly start to absorb over time. But for now, let's definitely agree on receivables, inventory, prepaid expenses are clearly working capital line items. So we're going to include that into our working capital schedule. And I've already done that. Right, in your Walmart template, we have receivables, inventory, prepaid expenses. I laid out the line items and laid out line items underneath for metrics that we'll use to determine what our projections should be. And so we can hard code the historical values into the working capital schedule, but because these are balance sheet items, my recommendation is to hard code them into the balance sheet and then link them in here. You could have done it the other way. I'm just trying to think ahead. Knowing that this is ultimately going to go into the balance sheet, I would recommend not to link the same numbers into two different places. So let's hard code in receivables, inventory, and prepaid expenses into the balance sheet to be linked in to the working capital schedule. So receivables, for example, let's just do receivables for now. I'm going to link in receivables. 2012 receivables is 5937. And you know what? I'm going to put in 2011 as well because we're going to do some averaging here. 2011 is 7395. So why don't you hard code that in? 7395, 5937. Sorry. It's 5937, 5089. Sorry. So 2011 is 5089 versus 5937. That's the receivable. So I'm hard coding them into the balance sheet. Because I'm thinking ahead and trying to skip a step, if you didn't, that's fine. You can hard code them directly into the working capital. And I'm just going to link this into the working capital schedule. So in operating working capital, receivables 2011, I'm going to link in from the balance sheet 5089. So I'm going to link these in. Again, you probably could have just hard coded it directly to here, but I'm trying to be extra. I'm trying to avoid hard coding things twice, is really what I'm trying to do. Okay, and so I mentioned the formula of working capital, of accounts receivable to be accounts receivable divided by revenue times 360, right? It's what percentage of receivables are of revenue, and that gives us a percentage, and we multiply that by 360 because that gives us an equivalent number of days in a year. However, to get a little bit more detailed, do I have an example here? I do have an example. This is the example I've given you guys before. I gave you 25,000 divided by 100,000. Here's, well, what if accounts receivable is 2,500 and the revenue generated is 10,000? That means of the revenue generated in a year, 25% of that revenue has yet to be collected. You multiply that by 360 to get us an equivalent number of days. So of 360 days of operations in a year, 90 days of those collections remain outstanding. That's the idea. But in modeling, you know, accounts receivable, balance sheet line items are an ongoing balance, right? So in other words, what did Walmart produce in 2012? Walmart produced $446 billion, right? That was how much it produced over a period. It produced $446 billion in sales over a period. The balance sheet information, though, is what's outstanding over a certain amount of time, right? So their receivables that were outstanding, that were yet to be collected, was 5,089 in 2011, and that increased to 5,937 in 2012. Nobody knows what's happened in the interim, right? That's the problem with balance sheet items. They could have collected $5 billion and generated $5 billion more, right? They could have, this could have popped up to $10 billion and then they collected $5 billion. Nobody knows what happened in the interim. This is just what's been outstanding at the end, right? In addition, maybe a better way to put this, if you calculate the formula just off of 2012, 5937 divided by the 444 billion times 360, who knows what the beginning of the year looked like? 2011 could have been 0. If 2011 was 0, that meant that they generated $6 billion over 2012. 2011 could have been 5937. If 2011 could have been if 2011 was 5937, then maybe this hadn't moved in a year. So for that reason, in the formula, we don't just take accounts receivable divided by revenue times 360. We look at the average. We look at the average of accounts receivable between this year and last year divided by revenue times 360. So just note that. We look at the average because this is a year-end balance. We don't know how this looks at the beginning of the year. So the formula that you should memorize now and come to slowly learn is the days receivable in 2012 equals the average. I'm going to do equal. So I'm going to do in F8 equals average, open parentheses, 2012 receivables, comma 2011 receivables. Got that so far? Equals average, open parentheses, F7, comma E7, close parentheses. You guys okay with that? Yeah? Divided by income statement revenue times 360. That will give you 4.4. 4.4 days, meaning 4 of the revenue generated, the equivalent of 4.4 days are left outstanding. Does that make sense? What's a standard level of receivables? Say again? It depends on the industry. I don't know. Amongst all industries, there's a standard. 30, 60, 90 days, something like that. So relatively, yes, it depends on the industry, but relatively 4.4 then is very low, right? Why? Is it unusually low? Is it explainable?
Cost of the product, I think, and credit in some cases, most people are typically paying cash.
People are typically paying cash. Yes. Why are people typically paying cash? Why wouldn't they be approved for credit? They're lower income shoppers, and why else? More directly. Well, and buying with a credit card is not a receivable. Because if you're Walmart and someone pays you the credit card, you're still getting that cash up front. The liability is on the bank. So receivables aren't based on customers coming and paying with credit cards. So based on that.
So that's just that a lot of the sales are to retail, but not to wholesale.
Yes, right. Yeah. Exactly. That's retail. It's retail. You're not contractors. You're not, you're not the type of client that is willing to let a customer defer, right? This is big box retailing stores where customers come in and they pay instantly. can't go into Walmart and say, I'll pay you in 30 days. Well, maybe. I don't know how their Walmart, if they have a Walmart-based credit card, I don't know how that works.
You have to set that up.
You have to set that up separately, yeah. But if you, and I don't know if that really counts here. But anyway, but it's not surprising that this is low because of the nature of the business that Walmart's in, is the short story. How do we look at inventory? It's kind of the same way. So let's first go to the balance sheet. I want to hard code in what the inventory is. So the inventory is 4714 in 2012. 4714. And in the year before, it's 36437. Right? And we'll link, right, so 36437, 4714 gets linked into the operating working capital schedule. 2012, I'm going to link in from the balance sheet. And why don't you, okay, so let's, and we'll calculate the historical days off of this. How's the formula change? Yeah, it's not based on revenue, it's based on cost of goods sold. Inventory is based on cost of goods sold. So the formula is going to be inventory divided by cost of goods sold times 360. Or the average, it's going to be the average last year, comma this year's inventory divided by cost of goods sold times 360. Take a shot at doing it. Let me know what you get. I'm going to save this. What do you guys get? Okay. Yeah. So the formula will be equal to, the formula in F10 is equal to average, AVER, open parentheses, this year's inventory, comma, last year's inventory, close parentheses, divided by income statement, cost of goods sold, times 360. $41.4, right? It's this year's inventory, comma, last year's inventory, divided by COGS times 360. Same idea, prepaid expenses. Move ahead. If you need more practice, this is repeated exactly in the book. Prepaid expenses, balance sheet. We're going to go through prepaid expenses is 1685 in 2012, 2920. Sorry, 2960. 2960, 1685, and 2960. Pull that into working capital. And so the question is, what is the supporting line item here, right, where receivables always relates to revenue. Inventories always relates to cost of goods sold. What's prepaid expenses related to? What kind of expense are you prepaying? Most likely something in SG&A. And you'd have to usually maybe do a quick word search to see if there's a note about it. If they talk about the expense they're prepaying, what's kind of makes it easy for us here is they have only one SG&A line. So that makes it, it's got to be that, right? It's not going to be COGS because COGS is related to inventory. And your working capital is related to anything above EBITDA. If you had a few line items within operating expenses, it could technically be any one of those line items. So you got to do a little bit of research. If you're completely in doubt, you could just do it off of total operating expenses. Sometimes we do. So we'll see as we do more models later. We'll see some situations where it might be like that. So for operating working capital, they're going to be equal to the average of this year's prepaid expenses, comma last year's prepaid expenses, divided by SG&A times 360. Okay. Divided by income statement, SG&A times 360. 10.8. Yeah. There's the formula. Anyone has questions, let me know. Anyone didn't get it, need extra help, let me know. We can add up the current assets, right? You don't want to do a total everything because you don't want to include the days. We can add receivables, inventories, prepaid expenses. Yeah? Okay. Now we go to the liabilities. So within the current liabilities section, which line items are related to working capital? Remember, it's anything that's not related to debts or extraordinary items. So short-term borrowings, not working capital. Eliminate that. Accounts payable. Yes, that's working capital. Accrued liabilities. Yes, that's working capital, right? Accounts payable is what's owed to manufacturers. Accrued liabilities, what's owed on expenses. Accrued income taxes. Yes, that's working capital. Long-term debt? No. It's debts. Capital leases due within 1 year? That's debts. You do not include that. And discontinued operations, again, I mentioned that's extraordinary, so we won't include that. So what we're really dealing with is the three line items: accounts payable, accrued liabilities, accrued income taxes. Those three line items. So let's use those three line items, link them in one by one, and calculate the historical days formula that we'll use to make our projections. So let's start with accounts payable. Accounts payable is 36608. We're going to go down to row 21, 36608, and 33676. Accrued liabilities. So okay, so let's pull that in into operating working capital. Accounts payable will be pulled in from the balance sheet. And using the same method, so hopefully you're getting familiar with the formula. The accounts payable is related to what? COGS. So we're going to look at the accounts payable divided by COGS times 360, or the average, right? So it's going to be equal to the average this year, comma last year's accounts payable, divided by income statement cost of goods sold times 360. 37.8. There's the formula. Let me know if you have questions. Yeah? Accrued liabilities. Same idea. Accrued liabilities. We have 18154 and 18701. 18154 and 18701. Pull that into the working capital. And again, take the average divided by what? What's accrued liabilities now? Accounts payable is what do you owe on COGS? Accrued liabilities, it's got to be SG&A. We really don't know. It's not defined, but it can't be COGS. That's accounts payable. So it's just got to be an other expense. The only other expense we can relate it to is SG&A. So we're going to take the average. Accrued liabilities this year and last year divided by SG&A times 360. 86. Guys got that? If you need a little bit extra time, I'm going to email this to you. You can go through the book. Accrued taxes. Same idea here. The accrued taxes are 1164 and 157. So 1164, 1164 and 157. We're going to pull in working capital. 1164. 157. What are accrued taxes related to? Income taxes. These are income taxes that you have not yet paid, right? How is that different than deferred taxes that we talked about last week?
I think that's the third one where we're going to pay down by year one, where the third tax will be the thing out.
Yep, that's exactly right. I'll repeat what was said. So there is a small difference, right? So deferred taxes, as we mentioned last week, is based on accounting differences from the way you report for GAAP purposes versus tax purposes. So we use the example of changing your method of depreciation, and that creates a deferred tax liability. That's usually a long-term liability. There's always short-term components of it, but it's basically a long-term liability, just like, you have a long-term debt, but there are short-term pieces of it. Accrued taxes is a little bit different, and I consider accrued taxes working capital, although it's up for debate because of the nature of it. Accrued taxes is literally, you file your tax returns March 15th, right? You file your tax returns March 15th, right, for a business. And so all of a sudden you file those tax returns, company owes $10 million. And you say, well, I don't have the cash for it yet. Can I pay this over 4 quarterly installments? But you got to pay those obligations by the end of the year. That's accrued taxes. There's no, I'm filing something for GAAP different than something for tax, and there's this long-term deferrable. This is literally, here's my bill from the IRS, I'm paying it in installments. So that's why this is considered short-term and a little bit more operational, because it's literally just a percentage of the taxes that are owed or expensed on your income statement. Obviously, there's different variations of both, but this is the way I'm separating the two. And that's why sometimes, I forgot what it's like for Walmart, but a lot of times when you calculate the days payable come out to be something like 265. Because what's happening is, you get billed and you're paying a quarter and you're deferring 3 quarters until the end of the year, until December happens, especially for a retail business, money comes in and then they pay it down by December 31st. That explains a lot of that. So I'm going to take a look at this as a percentage of taxes. So the idea is, a lot of times you might find one-off line items that are not as cut and dry, right? AR, receivables is always related to revenue. Inventory is always related to COGS. Payable, always related to COGS. Sometimes you might see line items that you have to kind of back into and guesstimate. Accrued salaries. Okay, well, that's part of SG&A. You can infer that from salaries. Accrued taxes. That's going to be part of taxes. Sometimes you might have to just kind of step back and guess, and there's no standard formula for it. So let's do this as a percentage of taxes. So this is going to be the average of this year related to last year divided by taxes, right? So divided by income tax expense times 360. Yeah. And that gives us, okay, relatively low number of days. And we will sum up the liabilities, accounts payable, accrued liabilities, and current liabilities. And we're going to take a look at the working capital. So the working capital is going to be the current assets less your current liabilities. It's your net assets. So the total operating working capital is going to be equal to total current assets, minus total current liabilities. So it's negative. So the question is that good? Is that bad? How do we think about it? I mean, what do you think? Is that good or is that bad? Let's take a break. Think about it. I want to talk about projecting it. I want to talk about analyzing it. What does it mean? And I also want to get into net operating loss carry forwards. That was a portion of the depreciation chapter section we didn't get into yet. It's kind of a one-off, but you guys are probably going to start to face that with your companies too. So let's take a break. I now want to get into translating these historical items into good projections. So we've calculated days, and if you want to go back further and get 2010 numbers and calculate 2011 days, you could do that. I usually go by taking the last year's days method. I don't like to average the days. To me, last year is most indicated of what's going to happen next year. It's let it be in the operation projections to focus on swings. So I'm going to assume, based on our historical calculation, that 4.4 days will be the norm going forward. So I'm going to hard code 4.4 for 2013. And so the question is, how do we use 4.4 days to back into projected accounts receivables? Well, we're just going to kind of reverse engineer the formula, right? Where the formula is AR divided by revenue times 360 equals days. We now have days. We want to solve for AR. Right? We have days, we want to solve for AR. So if we have days, if days are given, then we want to just do some algebra and reverse the formula so that AR is the output, so we'll just divide by 360. Or that cancels. And so now we have AR divided by revenue equals days divided by 360. And we're solving for AR, so we multiply both sides by revenue. And now we have AR equals days divided by 360 times revenue. That's the formula. And that should make sense. Remember we used the example of 25,000 in AR over 100,000 in revenue gives us 25%. And we multiply it by 360 days, that gives us 90. But the idea here is we want to get a percentage, right? How much of revenue generated remains outstanding. This backs into that, right? This backs into the percentage. Take the days divided by 360. 90 days divided by 360 gives us that percentage again. It gives us 25%. Multiply 25% by our projected revenue, and that gives us our future AR. That's all it's doing. So, in other words, we have days receivable. Take those days divided by our 360 number, that'll give us our percentage. Multiply it by future revenue. That's our projections. So we're going to do G7 equals G8 divided by 360 times the revenue, the projected revenue. Income statement G11. And we'll copy that to the right. And you do that same thing for each line item, right? You're just kind of reverse engineering the formula. That should give you 5790.5. So again, where for inventory, we had inventory divided by COGS times 360 equals days. Now you divide by 360, cancels that. That gives you inventory divided by COGS equals days over 360. And then you multiply by COGS. And then so the inventory, to get your future inventory, you take the days, your projection, divided by 360, that gives you a percentage, multiplied by the future COGS.
It'll suffice to hard code in days rather than just copy from the left.
Yeah, you can't copy from the left because then you're copying a formula.
Okay.
Right? If you copy this from the left, you'll start to get crazy things. It's averaging, that doesn't work. But it suffices to do 41.4. You could do this. Maybe this is what you meant.
That's what I meant.
That's what you meant. Yeah, you could.
Is that any happier?
You could. Just like when we did percentage of revenue for costs, I just said to hard code it to avoid any rounding differences. But either way, it's close enough. Yeah. If you want, if we're all matching numbers, let's just agree on hard coding 41.4. It should be blue. And so the future inventory equals the 41.4 divided by 360 times cost of goods sold. Average of what? Oh, yeah, you mean I didn't undo. So where do we begin? I mean, because this is basically the average inventory balance, right? I didn't undo that because these are projections. right? The nature of 4.4 should be an average of your projections anyway, right? If you want to if you want to undo the average, I actually wrote out the formula in the book, but it loses its meaning in the future. So you're saying you would take this and you would multiply it by 2 and subtract it from last year's inventory. I think it's meaningless. I comment on that in the book. I think it's over-engineering it. I mean, if you're not comfortable with 4.4 because of the averaging, then adjust your 4.4 days, right? Make it 5 days. Make it 4 days, you know?
So all of this is more of an art than a science.
Yeah. You're absolutely right. It is absolutely an art. I wouldn't call it an art. I'd call it I don't know. It's being recorded, so. And we'll copy this to the right. But you'll see, and the reason why I say that, and actually we'll focus on this in valuation, is you could do 41.4, you could do 40, you could do equals the year before, you could back into the average. These small adjustments won't affect our range of valuation, which is probably going to be about a $5 billion differential. So there's a lot of room for flexibility there. That's the open and closed stock price fluctuation in a day. It could be, right, in a volatile day. So we'll see how there are other things that you would tweak that would make a much, much larger impact on your valuation. Those things you want to focus on. That technique we'll slowly get into. Okay, so I took the 41.4 divided by 360 times the COGS. You guys okay with that? Prepaid expenses, same thing, 10.8. And so the formula is going to be the days divided by 360 times SG&A now. Okay, so this is going to be days divided by 360 times income statement, SG&A. You can copy that to the right. I'm going to copy the total formula to the right. Take a few seconds, see if you can catch up with that. And that process repeats going forward. Any questions on that? Okay. If you need some more time with that, you are welcome to it. But moving forward, accounts payable, same formula, same idea. But accounts payable is related to COGS once again. So actually, it's the same formula as this one, right? Well, let's use 37.8, and the formula would be those days, 37.8 divided by 360 times cost of goods sold, right? Accounts payable is related to cost of goods sold. Right? And you can continue. Accrued liabilities, 86. Sorry, 86. And the formula is equal to 86 divided by 360 times we looked at SG&A, right? SG&A. And accrued taxes, which is 29.9, which is the days, divided by 360 times taxes. Times income tax expense. So I did that a little bit fast, so let me know if you want me to look at formulas, if you want to look into formulas. Take a few minutes, copy the total. Okay, so I'm going to copy to the right this total operating capital line, which shows it continuing to be more and more negative, and that makes sense because we're using the same amount of days. Our company is growing and increasing, so that's just going to expand what's going on here further, and that's what's happening. I'm more concerned about the year-to-year change. I'm more concerned about the cash flow impact because really what this affects is your cash flow statement. Right? In the model, this is the only thing that impacts. It impacts the cash flow statement. So what happens from year to year? Well, first of all, let's look at the change. Right? So the change in total operating working capital is 2010 minus 2011. So working capital had increased in 2012, and it's slowly decreasing further, becoming more negative, more negative, more negative. As it becomes more negative, it represents cash coming into the business. The point of working capital when you guys model this, and if you were somebody that actually managed working capital, is you just don't want to see major swings. You want working capital to be managed, perfectly managed would be around zero, right? You are managing your collectibles and balancing them properly with your liabilities. Maybe as your business increases, your company increases, you're getting more credit, you're increasing your liabilities, you're increasing your assets accordingly as the company grows. That's the way you'd want to manage working capital. You want to do it in such a way that the year-to-year swings are not volatile. And that's how we have it here, basically. Around 500, 600. This is one exception here. But it's being managed well, it's being predictable, and it's not being a major draw or influence on the cash whatsoever. That's the way working capital should be. Our operations are steady, and the working capital should reflect that. That's the idea. That we'll learn more over time.
All those numbers are negative.
Yeah.
In my mind, it should be positive.
It's positive for cash flow, but it's declining. Yeah. Yeah. So how do we transfer this into the cash flow statement? Well, if you go to the cash flow statement, you'll notice there's this section called Changes in Operating Working Capital. Now, there's a couple things that are confusing about, there are a couple more things that are confusing about this. One is in modeling, and you've seen this in your DCF. If you guys have taken modeling courses, you've seen this. There's cash flow from operating activities. Right? Cash flow from operating activities starts with net income, which we have. Here's some other line items. We have depreciation, amortization, deferred taxes, and changes in operating working capital. However, if you go to the actual cash flow statement, which is usually the first one, in this case it's not. Okay. You have a similar structure, but it's important to note that this section here is not always operating working capital, even though we do that in modeling. It's not a GAAP requirement. So you're going to see differences. And I see a lot of you guys taking a look at these line items, comparing it with the balance sheet, and expecting it to match, and it'll never match. And there are reasons for that. It's a tricky thing, but in modeling, we want to make it match in the future, even though it won't match historically. But the biggest difference is you'll see we've identified 6 line items that are working capital: receivables, inventory, prepaid expenses, accounts payable, accrued liabilities, accrued income taxes. But the cash flow statement section, so let me just write this down. So we identified basically accounts receivable, inventory, prepaid expenses, accounts payable, accrued liabilities, accrued taxes. Right? However, that's what we identified. We identified that by going to the balance sheet, by looking at the current assets, not including cash and extraordinary items, and current liabilities, not including debt and extraordinary items. But in the cash flow statement, they only have 4 line items within that section. This is the balance sheet. The cash flow only has AR, inventory, accounts payable, and accrued liabilities. Right? So we have AR, we have inventory, accounts payable, accrued liabilities. What happened to prepaid expenses, and what happened to accrued taxes? That's something that you're going to find a lot. And that's a problem. When creating a working capital schedule in banking, the point of that is to find a balance between balance sheet working capital line items and cash flow statement line items. What happened to prepaid expenses in the cash flow statement? It could have been buried in some other line items, accounts payable. They've just defined it differently. Where's accrued taxes? It could be part of accrued liabilities. I mean, this is just one major problem that you'll find in modeling. So you have 2 options. One, you combine certain line items like accrued liabilities and accrued taxes in the balance sheet, or we create a second line item in the cash flow statement to account for that, to make it match. But we need line items that match to be a proper bridge between the balance sheet and the cash flow statement. You can never, and this is the problem, and you'll never, even historically it won't match. So let's say things that we know for sure. Accounts receivable, right? If you look at accounts receivable on the balance sheet, and we've hard-coded it properly here, the balance sheet AR went from 5089 to 5937 going forward, right? That's 848 changed. Accounts receivable went up by 848, right? That should represent cash outflow of 848 in accounts receivable. What does the cash flow statement show? 796. Not going to match. Inventory. Inventory's gone up from 36 to 40, so that's a change of inventory going up in the balance sheet should be cash outflow of 4277. Here it's 3727. It's never going to match historically. I've never seen it match. Oh, I've stopped trying it, so maybe it has been. But I mean, don't waste your time. The point is in modeling just to make sure you have the equivalent number of line items so your projections match, your projections balance. What happens is even management, they'll build the model, it'll match. Then there's asset write-ups and write-downs, and there's adjustments that are made, and then auditors come in to make adjustments to line items, and it's not going to match anymore. But you want to make sure that your model and your projections flow. So that's why I'm going through this process. And again, to avoid much confusion, the process is look to the balance sheet to determine what your working capital line items should be. That's what we did. Use the balance sheet. People are like, well, do I use the balance sheet or do I use the cash flow? Use the balance sheet as the base. Then build the working capital schedule off of the balance sheet like we just did. Build operating working capital. And then look at what cash flow line items exist and try to match them as best you can So that's what we did. So we did the balance sheet, we identified 6 balance sheet line items, we identified only 4 cash flow, where AR was a clear match, inventory was a match, AP and accrued liabilities was a match. There are these 2 line items we identified in the balance sheet that were not represented in the cash flow statement somehow. So you either add rows to represent that, or you consolidate somewhere. Let's just say let's add rows. So we're going to add 2 rows in our cash flow statement. Which we've already done. This is the wrong model. Sorry. 1 for prepaid expenses. No, we didn't. Okay, right there. 1 for prepaid expenses and 1 for accrued taxes. It'll be 0 historically, but at least the projections will match and flow, so we'll have a matching flowing model. Okay? We're going to do this again and again. Okay. So that's one thing to note. The other thing is, the whole point of this, whether the line items match or not, is we want to transfer these working capital changes into the cash flow statement. As we described before, if an asset increases, that represents a cash outflow. If an asset decreases, that represents a cash inflow. So, if we have from 2012 to 2013 a cash increase in accounts receivable, that should show as cash coming out. So I'm going to show this as negative, the change. So the way we transfer an asset into the cash flow statement is it'll be minus the year-over-year change because of the relationship between cash and an asset. If the asset goes up, cash goes down, or vice versa. So the 2013 changes in accounts receivable is going to be equal to minus, right, negative the change. Open parentheses, the 2013 receivables in 2013 minus 2012, negative the change. You could have just subtracted backwards if you wanted to, but just intuitively, it's minus the change. So it's going to represent the decrease from 5937 to 5790 should represent cash inflow. And it does. Copy that to the right. That's how it works. Same thing with changes in inventory. In the working capital section, we see inventory increasing. An increase in inventory should represent a cash outflow. You buy inventory, you spend money to buy inventory. So it can't be a subtraction of this year minus last year because that's going to show a positive cash. It's negative the change. Cash flow is going to be equal to minus, open parentheses, this year minus last year. Okay with that? Questions on that? Okay. Now here we come to, on the working capital, we have a line item that doesn't exist in the cash flow statement. We've identified prepaid expenses. Cash flow statement doesn't exist, so let's add a row for that. So I'm going to do Shift Spacebar, highlights the whole row. Control Shift Plus. I'm going to call it changes in prepaid expenses. And I'm going to make it 0 historically, so the historical number is still tied to what has been reported. but I'm going to calculate minus the change. For every asset, it's minus the change, always. It'll be equal to minus this year minus last year. Oops, forgot the parentheses. Yeah? Question on that? Okay. Accounts payable is now a liability. So for an accounts payable, we see accounts payable increasing from 36 billion to 37 billion. That should represent a cash inflow. It's not the opposite effect, right? It's not asset goes up, cash goes down. This is liability up, cash up. So this should be represented by the actual year-to-year change. So for changes in accounts payable, this is going to be equal to 2013 minus 2012. Not minus the change. It's the direct change because of the relationship between a liability and cash. If the liability is up, the cash is up. Any questions on that? Do the same for accrued liabilities, right? Accrued liabilities is going up from 18 to 19 billion. An increase in accrued liabilities is cash inflow. So again, we want to subtract. It's a direct subtraction. 13 minus 12. This would be equal to this year accrued liabilities minus last year's. Questions on that? And again, we have this one last line item, accrued taxes, that didn't exist in the balance in the cash flow statement. So I'm going to add a row to include that. I'm going to do Shift spacebar, Control Shift plus. I'm going to call it changes in accrued taxes. And I'm going to make it 0 historically. And the change, since it's a liability, it's this year minus last year. And you just want to make sure that this still impacts the total. And it doesn't. So just be careful that your totals include that new column. Does everyone have this? 606.9? And if everything is done properly, the match at the bottom should go from no to Y, meaning you've done everything properly. This is one of several matches we'll have in the model that will help error-proof the model. It'll cover a lot of very common mistakes. One of the most common mistakes in the model is you're subtracting things the wrong way. You're pulling things from the balance sheet into the cash flow statement the wrong way, right? You're showing an increase in an asset as cash coming in when it should be cash coming out. And this match avoids that problem. How does it avoid that problem? Well, you're calculating changes in working capital two different ways. On the cash flow statement, you're taking the change of each individual line item and adding up the changes. It's one way of calculating the changes. On the working capital schedule, you're getting the totals and subtracting the total from year over year. So you're calculating the change in working capital in two different ways, and if it doesn't match, that would indicate that you probably have the signs on either the working capital schedule or the cash flow statement backwards. So in the book we'll go through examples of that, but that's what the match does. You should start to be comfortable with that as you build that. So basically, again, the changes in working capital here is taking the total current line, the total working capital, and subtracting it from the working capital of next year. On the cash flow statement, you're getting the individual changes of each line item and adding up the changes. You're calculating it two different ways. So now that this matches, we have confidence that the working capital is properly represented in the cash flow statement, so I could take the yellow out. And we're pretty much done with the cash flow statement, with the exception of the debts that will come from the debt schedule. That's the last piece that you do. So we're pretty far along now. So then the next task that we have to do is now lay out the balance sheet and project the balance sheet. We're going to use this cash flow statement to project our balance sheet. So we'll learn that tomorrow.